January is when thousands of Canadians open their banking app, see fresh TFSA contribution room, and ask the same question. What should I actually invest in? Not what's trending, not what your coworker bought, not what's on Reddit, but what actually makes sense inside a tax-free savings account in 2026. The TFSA is one of the most powerful wealth-building tools in Canada. Your investments grow tax-free. Withdrawals are tax-free. And unlike the RRSP, you don't pay tax later. That means what you put inside this account matters, because every dollar of growth is permanently shielded from tax. So in this video, we are going to break down the best types of investments to hold in your TFSA in 2026, based on simplicity, diversification, long-term growth, and tax efficiency. Let's start with the foundation. For most Canadians, the best TFSA investment in 2026 is not a single stock. It's not trying to pick the next Tesla. It's not chasing whatever AI company is trending. It's a globally diversified ETF. An ETF, or exchange-traded fund, is essentially a basket of investments. Instead of buying one company, you buy hundreds or thousands at once. And for a TFSA, broad market ETFs are often the most efficient way to grow wealth over decades. One of the simplest options available to Canadians is an all-equity ETF like VEQT or XEQT. These funds hold thousands of companies across the US, Canada, and international markets. When you buy one share, you're instantly diversified globally. Why is this powerful in a TFSA? Because growth compounds tax-free. If global markets rise over the next 20 or 30 years, and historically they have, that entire growth stays inside your account, untouched by taxes. If you prefer slightly less volatility, you could look at a balanced ETF like VGRO or XGRO. These include both stocks and bonds. They fluctuate less than pure equity funds, which may help investors stay invested during downturns. The key idea here is simplicity. One ETF, broad exposure, long-term holding, no constant trading. Now let's talk about something many Canadians overlook. High-interest ETFs like CASH.TO. CASH.TO and similar products invest in high-interest savings deposits. In 2026, depending on where interest rates settle, these may offer competitive yields with very low volatility. If you're saving for something within a few years, a car, tuition, emergency fund, holding cash-like investments inside your TFSA can make sense. However, if your goal is long-term growth, cash is unlikely to outperform equities over decades. A TFSA is most powerful when used for growth, not just parking money. Next, dividend ETFs. Many Canadians love dividends. They feel tangible. They feel stable. ETFs like VDY or XEI focus on Canadian dividend-paying companies. Inside a taxable account, Canadian dividends receive favorable tax treatment. But inside a TFSA, that tax advantage doesn't matter, because everything is already tax-free. That means dividend ETFs are fine, but they're not inherently superior to broad market ETFs inside a TFSA. What matters more is total return, growth plus dividends combined. Now let's address individual stocks. Can you hold individual stocks inside a TFSA? Yes. Should you? That depends on your risk tolerance and knowledge. Concentrated bets can create massive gains, tax-free, but they can also create permanent losses. And here's the nuance. Losses inside a TFSA cannot be claimed for tax purposes. If you lose money on a speculative stock, that contribution room is gone permanently. That's an important risk most people underestimate. That's why, for most Canadians, broad ETFs form the core, and individual stocks, if any, are a small satellite portion. Now, let's talk about US stocks inside a TFSA. If you hold US listed dividend stocks directly in your TFSA, there is a 15% withholding tax on dividends that you cannot recover. It's not catastrophic, but it's something to be aware of. Canadian listed ETFs that hold US equities still experience some withholding at the fund level. But for most long-term investors, this is a minor drag compared to the benefits of diversification. In other words, don't over-optimize. Focus on the bigger picture. So what's the best TFSA strategy in 2026? For most Canadians under 50 with a long time horizon, a simple structure looks like this. One globally diversified ETF like VEQT or XEQT. Contribute consistently, reinvest automatically. Avoid frequent trading. If you're closer to retirement, consider adding bonds through a balanced ETF. If you're saving for a short-term goal, allocate part to a high-interest ETF. But the biggest mistake Canadians make with their TFSA isn't choosing the wrong ETF. It's not investing at all. Every January, billions of dollars sit in TFSAs as cash, earning almost nothing. Inflation quietly erodes purchasing power. The TFSA is not just a savings account. It's an investment account. And used properly, it can become one of the most powerful financial tools in your lifetime. The best TFSA investment in 2026 isn't about predicting the market. It's about choosing a diversified strategy you can stick with for decades. Because inside a TFSA, time is your greatest asset, and consistency beats speculation almost every time.